Okay, good morning. We are going to go through the rest of Chapter 3 today, and a little bit at the end we'll be talking about the exam. For those of you that have questions, I've gotten a couple questions in the chat room about ProctorU. I urge you to pick up the phone and call ProctorU and ask them your questions because they're happy to help you. So with that, we have a learning catalytics question going on right now, and so make sure you're logged into Learning Catalytics. We are going to close this question in a couple minutes. We'll leave it, and Haley will be pasting in the session ID in the chat room as we go. So I'm going to go through administrative announcements. And so if you're in class right now, you should be logging into Learning Catalytics because we are going to close this question fairly quickly after we get to that part. Okay, let's do Saturday. Saturday, September 20th, we have the Chapter 3 homework. We have an exam info quiz. The exam info quiz is available now. You get 2 attempts on it. It's just a multiple choice question about what we're doing, about what we talked about on the exam on Monday and what's on Blackboard. And then there's a Practice Exam 1 quiz that's due before you take the exam. I would urge you not to open it up until you're ready, and we're going to talk about the practice exam at the end of class today. But what's due this Saturday, the 2 things, homework on Chapter 3 and the exam info quiz. The practice exam is not actually due until before you take your exam. And then if you're in Section 3 and watching this later, you also have a regular quiz. Okay. So this chapter is stuffed full of stuff, and we're going to talk about in class, and it feels kind of unfamiliar, kind of confusing, and I would urge you to come to the Friday session. It is at 8 a.m. It was the only time Haley and I could find that we didn't have other things going on. And if you can't come to the 8 a.m. session live, online, know that it's recorded. So there's homework problems we are doing this Friday that we will not be able to do today in class just because we'll run out of time. And you don't have to watch that. That's totally optional. But if you're doing your homework and find you need additional help, do look for that on Friday. Exam is next week, September 22nd through the 24th. It ends at in the evening, no later than 9 p.m., which doesn't mean you could start at 9 p.m., etc. We have no class next week. Next week, your job is to take the exam. So you need to take the exam next week. That is your job. We do not have class next week. Exam info is on Blackboard, and we're going to talk a little bit about the exam at the end of class. Okay, just a last-minute plug. If you're an accounting major, email me for information on Meet the Accountants Night, which is tomorrow night. And then we're going to go into Chapter 3. At this point, we're going to do the Learning Catalytics question, so we'll display that. Okay. So on this one, you can select more than one. Okay, everyone physically in the room, do you need more time to answer or have you answered? Is Omar here? I bet he's online today. Okay, then online, has everyone answered? It's been open for a while. Anyone speak now? What? Okay. Okay, well, I'm going to wait 30 seconds and then we're closing this one. So Haley's keeping time in the background. But while I'm doing this, I'll just tell you, let's talk about, why don't we give until I'm done talking about the practice exam. I'm just going to insert that right here. So we are definitely cutting off the learning analytics when I'm done talking about the practice exam. So I'm going out of order. This is something typically I would have done the last minute of class. I put a practice exam in my accounting lab. And what I did to create the practice exam is there's 3 exercises on it and approximately 24 multiple choice or so. Every time you take it, it will be different. Okay? You can take it as many times as you want. It is set up to be very, very similar to the exam, both in terms of content and length and all of that. You have to take it at least once before you take the exam. If you take it, your score should be kind of represented, especially if you take it a couple times. That should give you a real good idea of what you're going to score on the exam. Keep in mind that on the exam, you do not have the Ask My Instructor button. You don't have the Help Me Solve This button, but those are on the practice exam, so you can get help as you're studying for it. You are likely to see several of the items in the practice exam on the exam. But that said, know that there isn't just one practice exam. Every time you click on it, when you finish it and do another one, it's a fresh one, so it has new content. It's designed to allow you to practice the material. You have to do it once. It counts as a quiz. It's due at the end of the exam period, so you can take it as many times as you want. In the syllabus it says you can take it 3 times. I thought, why should I limit you to 3? If you want to keep practicing it, go for it. This is something, it's meant to help you. There's also a button in my accounting lab called Study Plan. Study Plan has the same content, so if you prefer to work methodically through everything, you can go through Study Plan and start at the top and work your way down. Alternatively, if you think, I'm ready for an exam, let me try an exam, click on Take the Practice Exam. And again, you take it as many times as you want, and we're getting close to closing Learning Catalytics as promised. Any questions about the practice exam? Will it average all our scores together? Yes, your average on it will be the average of all attempts on it. Yeah. Okay, anyone else? Yes. How many questions? There are 3 exercises, and I'm not sure. I think about 24 multiple choice or so. It's in the range of 22 to 28 multiple choice. And it's about the same length as your exam. I cannot emphasize enough. Keep practicing it. And that should be, that's what your exam is going to look like. Yes? The what? No, it was available by today. It's not due today. Yeah. Okay. Any other questions? Any questions you have? Okay, close it. Okay, what's due? Chapter 3 homework is due today, or not today. I was listening to you. Okay, Chapter 3 homework is due this Saturday. The exam info quiz is due this Saturday, and the practice exam quiz is due before you take the exam. Okay, you have to know your My Accounting Lab login to take the exam. Your exam is in My Accounting Lab, which should make you happy because you're going to be able to take practice exams that feel and look like the exam. And you are likely to see content that's very similar. Okay, so let's get back. Are we going to do, is it me or you? Okay. You tell me when. That's soon? Just wave me down. Okay, Chapter 3. So Chapter 3, what we started with last time we talked about accrual accounting. We have accrual accounting, we have cash basis accounting. Cash basis, we only record transactions if there's cash involved. Accrual basis, we record transactions that involve liabilities and assets, not necessarily just cash. Accrual accounting has to be used by all except the very, very smallest businesses. And what we left off with on Monday is we had done an adjusting entry for prepaid rent. And we had said there's 3 types of adjusting entries. Adjusting entries are, and we did this on Monday. Adjusting entries are done at the end of the period. Now when we talk about end of the period, typically we're thinking end of the year, but they're done at the end of any period where we're going to be issuing financial statements. So adjusting entries can be made at the end of the month, at the end of the quarter. Whenever we're going to issue financial statements, we're doing adjusting entries. But we'll treat them in this class as though we're doing them at the end of the year for the most part. Every adjusting entry includes at least 1 income statement account and 1 balance sheet account, and we'll see that again coming up. There are 3 basic categories of adjusting entries. The definitions are in the PowerPoints. If you download those, they're also in the textbook. The deferrals are when cash has already changed hands. An example of a deferral is mower guy gets the $600 cash up front. Cash has changed hands, but he hasn't earned the income yet. So that's a deferral. Then depreciation is when we have equipment. So equipment or buildings, things that have a long life, more than a year, and that we use in our business are subject to depreciation, which is spreading the cost of that over their life, and we'll see that today. And then accruals are cash will change hands later. So an example of an accrual is we've used electricity all month. It's the end of the month. We're not paying our electric bill till next month, but we still have to recognize the utility expense. Prepaid expenses, we did prepaid expense. We did one example last week, or last Monday, where we said here's prepaid rent. We pay rent in advance, and then at the end of the period we need to recognize that we've used some of that rent and then adjust the rent balance. So what we're going to do now is we're going to do an example of supplies. Supplies are another prepaid expense. So in this example, we have Freddy's Auto Shop is the example I'm going to use throughout the day today. And I believe this example is also in your textbook. But on June 2nd, Freddy's Auto Service paid cash of $700 for cleaning supplies. So cleaning supplies, this is like the Murphy's Oil soap. This is paper towels. We bought supplies, which are consumables. We use them and they're used up, and they don't have a long life. We use them once and they go away. So we bought cleaning supplies for $700. Did Freddy's Auto Supply use supplies on June 2nd? Chances not. You go buy supplies, they're going to last you for a little while. So that what happens June 2nd is simply a transaction, and we would have recorded this. We would have done transactions like this in Chapter 2. So this is not an adjusting entry. This is simply saying on June 2nd we bought supplies for cash. So we're going to debit supplies, credit cash. And right now I'm going to quit saying it for the rest of today, but every journal entry we do today is a good journal entry to put on that sheet. Because there's some, and I'll show you some examples in your book, some summary pages that are good. But these journal entries, if you buy supplies for cash, you don't have to rethink the journal entry every time. Every time you rethink a journal entry, you run a risk of getting it wrong, switching the debits and credits. So why not just have this list of entries so when you pay cash for supplies, you know you're always going to debit supplies and credit cash. So this is what happened on June 2nd, bless you. And we have June 2nd, we have supplies debiting. Remember on a T account, we debit on the left, credit on the right, and then cash, we have that credit for $700. So what we have here is we're posting our entry, so we have our T account. So we haven't done the adjusting entry yet. We've simply said, here's what happened on June 2nd, we bought the supplies. Now the next bit of facts we're given is a count at June 30th. So now a month's gone by. We go to the supply closet. We count what we have left. So we've done an inventory, and that inventory says we have $400 of supplies on hand. So we purchased $700 of supplies, and now it says we have $400 left. So we know what we used, right? We don't even have to have a formula for that. We say, boy, we purchased $700, we only have $400 left. We had to have used $300. So what we'll do here is we use supplies of $300. So our adjusting entry is going to be to debit supplies expense. We're increasing supplies for $300, and we're going to credit supplies for $300. So we're crediting the asset. We used it up. So our asset is not worth, it's worth $300 less because we've used $300 of it. So this is our adjusting entry. Our adjusting entry for when we use supplies is to debit supplies expense and credit supplies. Now what we're going to do is those T accounts in the bottom, we have one for supplies and one for supplies expense. Supplies has a beginning balance of $700 because of that June 2nd transaction. So right now, before we post this adjusting entry, we have supplies on our balance sheet for $700. We know that's not the case. We know we should only have $400 in supplies. So what we're going to do is we're going to post this entry, which is the process of taking the debits and credits from the journal entry and putting them into the T account. So we're going to, that credit to supplies comes down to the right-hand side of the supplies T account. The debit from supplies expense goes down to the debit side of the supplies expense. And then we have a new balance in supplies. So our new balance in supplies, we take our $700, subtract $300, we get our balance of $400, which is what the facts told us. The facts say we only have $400 of supplies left. That's what we want on our balance sheet. Our balance sheet is a listing of what we own. So we want it to reflect what we own. We own $400 of supplies now. $300 of it was used. The practice exam is not timed, by the way. The real exam is, but the practice one, no. I mean, that's to say, so that's an interesting question. The practice exam is not timed, but keep in mind the real exam you have 120 minutes, so you may want to set your own watch and see if you can do it in 120. You should be able to, but it's not timed. Okay, so that's the supplies journal entry. The supplies adjusting entry. We're going to do a question now. Right, Haley? Refresh. Okay. Okay, there's a question up. Okay, I'm just not going to worry about it. It doesn't now? Okay, I'm not. Yours doesn't even go. Okay, well, I'll look over your shoulder. I'll stand over here for a moment. Okay. Okay, so, well, I'm not going to look at that. So, which of the following is not one of those three categories of adjusting entries? You have about 5 seconds left. Expenses are not a category. The adjusting entry categories are deferrals, depreciation, and accruals. The acronym would be DAD if you do them in a certain order. We do now? I think so. Okay, we're going to do two more, and these are review for Monday. So we're going to see how we do. A customer pays Starbucks $250 on March 15th for coffee to be served at a party in April. Has Starbucks earned the revenue March 15th? So March 15th, Starbucks gets the cash to serve coffee in April. Have they earned the revenue on March 15th? Mm-hmm. There, I went back in. Yeah. Okay, final 5 seconds here. Yeah, came back on again. Okay. Okay, you're 5 seconds and it's done. So give it 5 right now. Mm-hmm. Starbucks will not earn that $250 until they perform the service, until they deliver the coffee in April. So they do not recognize revenue on March 15th. We have one more review one, and then we'll go back to the adjusting entries. Starbucks pays $6,000 on, can you refresh? Starbucks pays $6,000 on July 1st for store rent for the next 3 months. Has Starbucks incurred an expense on July 1st? The dates are very, very specific there. So Starbucks pays $6,000 on July 1st for store rent for the next 3 months. So this rent's for July, August, and September, and it's asking, has Starbucks incurred an expense on July 1st? Just let me try this. Yeah. Okay. Okay, 5 seconds, get your response in. The answer is no, and here's the reason. When they pay rent July 1st, they're paying it for the entire month of July, for the month of August, and the month of September. On July 1st, they have not used up that rent. That is not used up until the end of July. So they have not incurred the expense until time has gone by. July 1st, they've not used that up. So the answer would be no. They have not incurred an expense They do not incur expenses until they use it up. And in this case, when it's rent, it's time going by. So now we're going to go back into the chapter. Depreciation of plant assets. So we have deferrals, which deferrals are when we pay things in advance or collect money in advance. And then we have depreciation. Depreciation is a whole other chapter later on, but we have just a little bit in this chapter. I don't want to emphasize it. We need to know certain things. First of all, depreciation deals with these assets with very long lives, a building, equipment, land, things like that. So we have these things called plant assets: land, building, equipment, furniture, delivery vehicles, things like that are considered plant assets. When we purchase these things, they are assets when we purchase them. With the exception of land, everything else wears out over time. It could wear out over a very long period of time. But when it wears out, we have this process called depreciation. So depreciation, let's talk about what it is. Because again, we'll focus on this topic in a later chapter, but we have some real fundamental things in this chapter. So let's just start the process. So June 3rd, Freddie's Auto Service purchased equipment on account for $24,000. So this is a transaction we would have done last chapter. This is one of those fundamental journal entries. So on June 3rd, Freddie's would have debited equipment for $24,000, credited accounts payable for $24,000, and then to post those to the T accounts, we would see that debit to equipment, the credit to accounts payable. So debits on the left, credits on the right. So all we've done is we've recorded the transaction and posted that to the account. So this is not the adjusting entry. This is simply saying this is what happens when we purchase equipment. So now, over time, that equipment will wear out. So on this next page, it tells us Freddie's equipment will remain useful for 5 years. So someone decides what this equipment's useful life is. It's always estimated. It's our best estimate. For our purposes in here, you'll always be told what the useful life is, and it'll be worthless. So they've looked at this equipment, said we'll be able to use it for 5 years, and then it's done. So what we're going to do in this chapter is we're going to say, okay, so there's lots of ways to allocate the cost over the life. But the method that we're going to look at in this one basic fundamental chapter is just straight line. We're just going to divide it by 5 years, basically. So we're going to say, okay, let's take our $24,000, divide by 5 years, and that gives us depreciation of $4,800 a year. So if our equipment costs $24,000, it's going to last for 5 years, divide it by the 5 years, and say $4,800 every year is wearing out. It's, you know, the equipment may not wear out at that pace, but that's what we're doing from an accounting standpoint. We're going to spread the cost of it over those 5 years. Now, this is for the whole year. They didn't buy this equipment January 1st. They bought it in June. So we can also calculate how much per month. And all we're going to do there is we're going to take the $4,800 per year, divide by 12 months. So basically we're saying it's $400 a month depreciation. That's all we're doing here is we're just saying how much a month. We know it's $4,800 a year. $4,800 divided by 12 months, $400 a month depreciation. So for straight line depreciation, which is all we'll do in this chapter, you divide by the life. And you might need to put it in months depending on what you're being asked. And then the adjusting entry for depreciation is going to look exactly the same over and over. The adjusting entry for depreciation is always going to debit depreciation expense, credit accumulated depreciation. and that's a new account. Let's see, where are we? Okay, so here's the depreciation journal entry, and then I'm going to talk about it. So, okay, our depreciation adjusting entry is to debit depreciation expense, credit accumulated depreciation. You don't necessarily need the hyphen equipment. Equipment's going to have its own depreciation expense. If we had cars, it would be depreciation cars, depreciation building, whatever it might be. So the important thing is that we debit depreciation expense, credit accumulated depreciation. And in the next slide, I'm going to talk about depreciation, accumulated depreciation. But this is the adjusting entry. Every month when we do depreciation, we're going to debit depreciation expense, credit accumulated depreciation. Okay, so when we post those to our T accounts, we will see depreciation expense gets the 400 debit, and accumulated depreciation gets the credit for 400. These two counts here, equipment and accumulated depreciation, are linked together. Okay? Accumulated depreciation is called a contra asset. We'll see it on the next slide. But accumulated depreciation is a contra asset. It is exactly backwards from equipment. Equipment is an asset. It has a companion account called accumulated depreciation. Accumulated depreciation, like its name states, is an accumulation of all the depreciation to date on an asset. So it's a running total of all the depreciation. We do not take depreciation out of the asset equipment. When you see an asset, that's its original cost, period. So our original cost of our equipment is $24,000. It's going to stay there until we sell it, basically. The accumulated depreciation holds all the depreciation. So we always look at those two together. We always have equipment, we always have accumulated depreciation. They offset, and the difference between them is net book value, and that's what we're going to see on this next slide. Okay, accumulated depreciation account. So that's where we're seeing that contra asset. And the contra asset, again, that's worth emphasizing. Okay, contra asset has a normal credit balance. It offsets the asset. It's going to be the running total of all the depreciation to date. I got an email question from someone that asked me the difference between depreciation expense and accumulated depreciation. And here's the difference. Depreciation expense is the depreciation for 1 year. Towards the end of class today, we're going to talk about something called closing entries, but expense accounts start over the next year. We don't carry expense from this year and add it to expense next year. So expense accounts start over every year, and when you look at an expense account, it's the total for a year. Okay. On the other hand, accumulated depreciation is a running total from the beginning of owning that asset. So accumulated depreciation is a balance sheet account, so it has a total, and it's always the sum of all the depreciation expense to date on an asset. Okay, and then we're going to see, so a contra asset is a companion to the asset itself. You always look at them together. It's an offset to the asset that represents its depreciation. So what we'll see on this next slide is where it comes into play. Equipment is here. Equipment minus its accumulated depreciation will give you the book value. In this particular one, depending on what they're asking, here they're looking for the book value of all plant assets. So we have land, and then we have equipment, and we subtract the contra asset accumulated depreciation. And once we do that, we have the book value. Book value is always the asset minus its accumulated depreciation, period. That's all it is. So book value is this total of the asset minus the contra asset. Land is worth mentioning here. Land is never, ever, ever depreciated. We'll talk about that in a future chapter. But land is considered to have an infinite value. It doesn't get used up or worn out. Land's there. But a building will crumble eventually. Equipment will wear out. So they're depreciated. Land is never depreciated. The contra asset is on the credit side because it offsets the equipment. It's on the credit side because you subtract it from the asset. The asset has a debit balance, and the accumulated depreciation is a credit, so you do subtract it. So to get book value, always subtract accumulated depreciation from the asset itself. We're going to see depreciation in a minute when we do a homework exercise, but now we're going to look at accrued expenses. And accrued expenses are expenses that we've incurred but haven't paid yet. In our example, we're going to go through salaries example. So with salaries, let's assume that our Freddy's Auto Service has an employee who is paid a salary of $1,800 per month, paid on the 15th and the 30th of every month. So on the 15th, the employee gets $900 for the prior 2 weeks, and on the 30th, the employee gets $900 for the second. Okay? So what happened, so let's say in our little scenario here in the book, June 30th falls on a Sunday. And this company, if pays on a Sunday, it shifts the payment to the next day. So pay is actually being paid July 1st. So first of all, let's go back to June 15th. So June 15th, Freddy's would have paid the employee $900 cash. So we would have, this is just a transaction, this is not an adjusting entry. So we would have debited salary expense and credited cash for the $900. So that's simply a transaction as we've done in the past. Now, when it comes time for June 30th, we're not paying the employee, we're not paying the cash until July 1st. But we can't just ignore it and say, well, we're not going to include it. We can't do this entry that we see right here on June 30th because we're not paying cash. We're saying, boy, we still have salary expense. This employee worked for 2 weeks, so we have salary expense that belongs in June, but we're not paying the cash. So what we're going to see on June 30th is we have salary expense same. Okay, so we know that the employee has worked. But June 30th, we're not paying the cash. What we're doing is we're setting up a liability called salaries payable to say we owe this employee. So when we prepare our financial statements on June 30th, we will show a liability for $900 because we want to convey to our users of our financial statements what we own and what we owe. And we have a liability June 30th to this employee. The $900, when we're looking at it right now, it's not a big deal. It's only $900. But we have lots of adjustments to make. So we have to make sure that we're reflecting all our liabilities and all our assets correctly. So what we see then on June 30th is we have salaries expense again and salaries payable. So June 15th, we had $900 of salary expense and we had cash credited. Then June 30th, we have $900 of salary expense and salaries payable of $900. So then July 1st, this is not here. But July 1st, when we make the payment, we're going to be debiting salaries payable to wipe that out and credit cash. So we have to recognize our expenses even if we haven't paid the cash yet. And usually that's with some payable account. Okay. Okay, Haley just pointed something out. When I have these examples, A, B, C, D, those are the headings in Excel. Okay, so that's column A, column B, column C, column D, because you can do a lot of this work in Excel. Okay, there's been some confusion that people think the C stands for credit and the D for debit. It doesn't. Those are Excel headings. The debits are always in the left column, credits are always in the right. Okay, so, and I'm still going right. You're not. You'll tell me when we're. Okay. Okay, we can also accrue revenue. Revenue, the cash has not changed hands yet. We're going to have two examples of revenues. We're going to have accrued revenues and deferred revenues. So the first one, let's say that FedEx hires Freddy's on June 15th. FedEx is going to pay Freddy's $600 monthly, the first payment on July 15th. So Freddy's is earning this money steadily, but they're not getting their money till July 15th. So on June 30th, Freddy's needs to accrue revenue that they've earned. They've earned half of the $600 by the end of June. They're going to get their payment in July, but they've earned half of it in June. So what we're going to see is we're going to see accounts receivable because they're owed $300 and credit service revenue. So this is accruing revenue that we're due, but we've not received the cash yet. What you've got down below in the T accounts, okay, in the T accounts below, this example is in your book. Accounts receivable had a beginning balance of $2,200. Service revenue had a beginning balance of $7,000. Accounts receivable has a normal debit balance, so it's on the left. Service revenue has a normal credit balance, so it's on the right. Those facts were given in the book. We don't need to do anything with those. I'm just explaining where those numbers come from. So now I'm going to post this entry. So accounts receivable debit goes down to accounts receivable. Service revenue gets credited to service revenue. So if I were to drop balances in those accounts after this, I would have $2,500 in accounts receivable. So on my balance sheet would be $300 higher. I would have $2,500 accounts receivable, and service revenue, I would have $7,300 balance. So that's accrued revenues where I haven't received the money yet. The next one, we have unearned revenue. Unearned revenue is I'll do this example and then I'm going to talk about an example in real life. Let's say Home Depot engages Freddy's Auto Service to perform routine oil changes on Home Depot trucks, agreeing to pay Freddy's $400 a month beginning immediately. So they're paying, Home Depot's paying in advance. They're saying, here Freddy's, here's $400, and on June 15th they pay $400. Now when they pay this, this is like our mower guy. Freddy's is getting $400. So we're going to debit cash, credit unearned service revenue. Unearned service revenue, this is important. Unearned service revenue is a liability. This will continue to trip people up the whole semester, but we need to know this is one of those accounts that doesn't look like what it is. It's unearned service revenue. Unearned service revenue means you owe that money. That's a liability. It is not a revenue account. It is a liability. So June 15th, Freddy's gets the $400 from Home Depot. They haven't done any work yet, so they have a liability. Now the end of the month comes, and they've earned half of that because this is for a month. June 15th to June 30th is half a month, so we're going to say, well, we've earned half of it now. So what Freddy's is going to do on June 30th is debit that liability, debit unearned service revenue for $200, and credit service revenue to recognize that they've earned $200 of this. And then, okay. So what we're doing here is we're reducing the liability and we're recognizing that we earned half of it. Switching over to real life here. The day that LeBron announced that he's coming back to Cleveland, within 3 days the Cleveland Cavaliers had sold out their season tickets. Now, that's a pile of money they're getting for these season tickets. The Cleveland Cavaliers, though, did not recognize any revenue in those transactions. Every time someone paid for season tickets, that is unearned revenue to them. That is a liability to the Cleveland Cavaliers. The Cleveland Cavaliers can collect all this money up front for season tickets, but it is not revenue, it is liabilities. So they've got liabilities growing on their balance sheet. They earn the revenue as each game is played. Each game is played, they can recognize revenue from those season tickets for that portion of it. Same thing, if you buy concert tickets from a concert promoter, they do not have revenue until that concert is performed. Until that concert's performed, they have a liability. Okay? So unearned service revenue is a liability. We don't recognize it till we actually perform the service. Okay, now coming up here I have a series of exhibits from your book that I just wanted to point out. Exhibit 3-6 has prepaid accounts and accruals. So 3-6, Exhibit 3-6 is a really nice summary. On the left side are the original transactions. On the right side is the entry, the adjusting entry. Oh, it depends. On the prepaids, the original entry and then the adjustments on the right, and when you get to the accruals, it's backwards. But there's a nice summary of the accruals and prepaids on Exhibit 3-6. When we make adjusting entries, we're doing it for two reasons. We're doing it, first of all, to measure income correctly. So we're impacting the income statement. The second thing is we are also updating the balance sheet. Every adjusting entry impacts a revenue or expense and an asset or liability. So every single time we make an adjustment, it is impacting the balance sheet and the income statement. Every adjusting entry will impact both of those. We're trying to measure income correctly and the balance sheet correctly. What? You're ready for the question. So you? Okay. Okay, we're going to do a question and then we're going to continue after that. Okay. Okay, what type of account is unearned revenue? We're going to close this soon, so get your answer in. Okay, 5 seconds. What? When did it? Let me do it. Yeah, you're good. Okay, close it. Okay, unearned revenue is a liability. Do you want to refresh? Unearned revenue is a liability. By the way, these questions that we have in class, similar to what you're going to see on the exam. Remember that you can always go back into Learning Catalytics after a few hours after class and review those questions if you wish. Put another plug in for the practice exam there. Gives you more practice. You're not sharing anymore. Okay, well, do your question. You're going to have to share, though. Okay, we're going to do another question. Haley started one. Okay, what type of account is prepaid rent? I'm going to look over your shoulder. I don't have it. Okay. What type of account is prepaid rent? We did an adjusting entry for this one at the end of Monday's class. Okay, you want to get your answer in. Okay, another 5 seconds. Prepaid rent is an asset. Okay, it's when we pay our rent in advance, and it's the rent that we still have able to be used in the future. Now, I'm going back. And here I'm just pointing out another exhibit in the text that's useful. Exhibit 3-8 gives you a nice summary of some of the adjusting entries. Really nice examples. Again, if you have this example, you can see, for example, prepaid rent expired and the adjustment that's needed. So this is a nice exhibit to use, 3-8, and it continues on its multiple panels. It won't all fit in one slide. Okay, so now that brings us to something called the adjusted trial balance. We talked last chapter about a trial balance. What a trial balance is during the period we have transactions. So we write the journal entries for the transactions. And then our transactions, next we post the transactions to the accounts. And then at the end of the period, we add up we list all the account balances in a trial balance. So we have all the assets first, liabilities, equity, revenues, expenses. And we add up the debits, we add up the credits, they equal each other. The whole purpose of a trial balance is to make sure your debits equal your credits. So then we go through the end of the period now, after we do make sure our debits equal our credits, then we do the adjusting entries. And the adjusting entries are done, and then we prepare something called an adjusted trial balance. An adjusted trial balance says all the adjustments have been made. So we have a trial balance, which is a separate thing from an adjusted trial balance. An adjusted trial balance is what we use to prepare our financial statements from. So we're going to be using the adjusted trial balance to prepare the income statement, balance sheet, statement of retained earnings. Okay. Exhibit 3-9, if you'd like to see an adjusted trial balance, this is actually an Excel sheet that columns B and C are the trial balance, columns D and E are the adjustments, and then column F and G are the adjusted trial balance. So the financial statements are prepared from that final 2 columns. That's all that is. Okay, we're going to do a couple of homework problems now. Exercise 3-7. Exercise 3-7, we're doing 2 things back to prepaid expenses. So on October 1st, Paradise Travel prepaid $6,000 for 6 months' rent. Give the adjusting entry to record rent expense, include the date, and post all amounts to the accounts involved. So there's a lot going on in there. So this first one, what we're going to do is we're going to do the adjusting entry. We prepaid $6,000 for 6 months interest. That means that's $1,000 a month, right? So this is October 1st. October 31st, we have to do the adjusting entry. We used 1 month of rent. So we have rent expense debited for $1,000 and credit prepaid rent for $1,000. Whenever you're doing a prepaid rent adjustment, we're always going to debit rent expense, credit prepaid rent. It's a matter of how much. And we paid $6,000 for 6 months rent, so 1 month has to be $1,000. Next up, what we're going to do is we have to, it says to post the amounts to T accounts. So all we're going to do is write T accounts and prepaid rent, talking through this. October 1st, we had $6,000, we purchased it. October 31st, we had $1,000 used up, so we have $5,000 left. That makes sense. We have 5 months of rent left October 31st, $1,000 a month. We have $5,000 left. And rent expense simply has the $1,000 rent that we used up for October. Now, Part B. Part B, we are told to, they paid $950 for supplies on October 1st, and then October 31st, they have $270 of supplies on hand. So they paid $950, they have $270 on hand, so they need to make an adjusting entry. So what we're going to see in B is make the required journal entry at October 31st. Well, supplies expense, we know when we do a supplies entry, we're always going to debit supplies expense, credit supplies, and the amount is the $950 that we started with, less what we have left has to be what we used. Okay, so we have the supplies expense journal entry, the adjusting entry, and then to post to the accounts, at this point there's nothing too exciting. We have a credit to supplies of $680 and a debit to supplies expense. And of course when we purchased it, that's $950 would be debited. So that's what we've got going on in the 2 supplies related T accounts. But that's the one. Okay, then we're going to go straight to 3.8. This is another short one. This is just to illustrate depreciation. Okay, so on this one, we purchased equipment for $35,000. So we have to make the journal entry to purchase the equipment, to do the adjusting entry, and post the T accounts. So what we're going to see here for the purchase of the equipment on January 1st, we're going to have cash debited, or equipment debited for $35,000, cash credited, and that's to purchase our equipment. The depreciation journal, again, we're debiting depreciation expense, crediting accumulated depreciation. The hyphen equipment is totally optional. It's not minus equipment, it's just hyphen equipment on both of those. And how I got the $7,000, I took the $35,000 that we purchased it for. It has a 5-year life, we're told. Divide the $35,000 by the 5, and that's $7,000 a year. So our adjusting entry for depreciation is always going to be depreciation expense debited, credited, accumulated depreciation. Now requirement 2 says to post to the accounts and show their balances at December 31st. So all we're doing here is we're taking those 2 entries and putting them in T accounts. So we will see, and we don't even need the balance lines. There's only one piece of information in each account. So you can have equipment, $35,000, depreciation expense has a debit balance of $7,000, and accumulated depreciation has a credit balance of $7,000. So you don't absolutely, I think in your homework you do have to acknowledge that that's a balance and that's why you're drawing that line, but there's only one activity going on in there. Okay, and then the third requirement is really where the meat of the question is. What's the equipment book value? The equipment book value is always going to be the equipment asset less its related contra asset of accumulated depreciation. So what you're going to see here, you have equipment of $35,000 less the accumulated depreciation of $7,000, giving us a book value of $28,000. Accumulated depreciation is a running total of all the depreciation to date. We only have 1 year at this point, but after next year, they would have another $7,000 in there, and the book value keeps dropping over time. What we're going to do now, I want to put another plug in for Friday. We're going to be doing several homework problems on Friday. We're going to do one question now, and then we have to do the last learning objective in the chapter. Fresh. Okay, the revenue principle requires that a business record revenue when what? What happens? Okay, get your final answer in. We're going to be closing this in 5 seconds. Revenue is recognized when the business delivers the goods or services to a customer. Doesn't have anything to do with cash changing hands. It's when we when we deliver the goods or services. Okay, and the final learning objective in the chapter, oh, I can't believe I just did that. We're not going back to the beginning. Okay. Oops. Right here. There we go. Okay, close the books. At the end of a year, we've got a certain amount in the revenues account. We've got a certain amount of expenses. We do not start next year with revenue or expenses. There are certain accounts that we have to close out. We have to zero out. We don't close out assets because we still have our cash. Just because December 31st came and went, we still have cash, we still have our assets, we still have our liabilities. We have to close the temporary accounts. There are 3 types of temporary accounts. Can you change? Well, you have to, yes. Okay, so we're going to close the books. And we close 3 types of accounts. We close revenues, expenses, and dividends. Revenues, expenses, and dividends, it's an RED acronym. And all we're doing is zeroing out those accounts. And we have 3 closing entries that have to be made. The closing entries are essentially the same over and over. The first closing entry is to close our revenues. To do that, that's entry 1. This is Exhibit 3-13. Entry 1 is to debit service revenue and credit retained earnings. We are zeroing out the service revenue and putting it all in retained earnings for the year. The second entry is to zero out all our expenses. So we're going to credit every single expense. This is a closing entry that will be different depending on what your list of expenses are. You may not have rent expense. You may have office expense instead or something, but you'll close every single expense account by crediting it, taking the total, adding it up, and that's what you get for the debit to retained earnings. And then the third closing entry is to debit retained earnings for the amount of dividends. So what we end up with is if we look at a T account of retained earnings, we would have the beginning balance, the revenues, the expenses, the dividends gives us the ending balance. Closing entries are meant to zero out revenues, expenses, and dividends. The net effect of all that goes into retained earnings. So retained earnings is this running total of all our earnings to date. That's Exhibit 3-13. What I want to do right now is, well, put a plug in for Friday. We're going to do some more exercises on Friday. But what I want to do is I want to switch and talk about the exam again, just to make sure we're all on the same page. Okay, exam is Monday, Tuesday, Wednesday next week. It's over chapters 1, 2, and 3. This is information I talked about on Monday, but I want to make sure we're all on the same page. On Monday and Wednesday next week, we do not have class. Your job next week is to take the exam. All times are Eastern Standard Time. If you're in sections 1 and 2, you take it in the computer lab. Again, you go to your Blackboard. Your Blackboard is customized for you. Sections 3, 7, and 8, you take it online with ProctorU. If you have any questions about ProctorU process, call them. Pick up the phone and call ProctorU. Talk to them. Make sure you test your equipment before the exam day. You do get 1 page of notes on the exam. Remember that this is not printed anywhere else. There is a 10-point bonus for taking the exam on Monday next week, period. There's no exceptions. If you take it on Monday, you would get the 10-point bonus added to your score sometime late Monday night or early Tuesday. You take the exam, you submit your exam, your score is your unadjusted score. I physically will have to add your bonus points to it sometime Monday night or Tuesday morning. You have to submit before 9 p.m. or you do not get the bonus points. If you submit at 9:01, you don't get the bonus points. There is no curve on the exam. The score you get is what you earn. Basic rules, be familiar with this. Detailed exam information is on Blackboard. Any issue during the exam, do not, if the proctor says, don't worry, I'll contact her for you, do not do that. That proctor, this is not their exam. This does not matter to them like it matters to you. If there's any issue, which I hope there's not, there's usually very few issues, but if there is an issue, I need to hear from you right away. And I will be monitoring my email constantly. Don't procrastinate. Your exam is in My Accounting Lab. You need to be able to log into My Accounting Lab. Exam info quiz is due this week. It's over this and the exam information in Blackboard. You get 2 attempts. Your score is the average. So if you get 100% on it the first time, you don't need to take it again. The practice exam, we talked about this at the beginning of class. This is a really good tool to prepare for the exam. This should give you a good idea of how you're going to do. Know that those aids on it that help me solve this and ask my instructor are not on the exam, but I left them on the proctor exam for you. Also, the practice exam is not timed. You have 120 minutes for your exam, so just keep that in mind as you're practicing for it. Okay, questions? Okay, I will see you in a week.